But I want to get to the broader markets, and we have a Fed meeting next week, and there's a lot going on in rates as well. So let's bring in Rieder. We have a ton of economic data coming out at the top of the hour, Rick, and normally we would have also jobs data today. That's going to be pushed forward a couple of weeks, or back a couple of weeks, I should say. And this leads me to my main question. Why would the Fed meet next week if they're not going to get the big jobs number out until after their meeting? Why not delay your Fed meeting, break up your precious schedule, get a little closer to Christmas? I get it. Everyone wants to be home for the holidays. But isn't the U.S. economy important enough for them to do that?
It's a great question, Matt. I mean, listen, I would say one thing. I think there's not a lot of ambiguity about the velocity of hiring in the United States today. I mean, you see, obviously, we got the ADP data, the claims data we got yesterday, but that's pretty ambiguous because of the timing around the holiday. But boy, you see it in terms of where companies are going. I mean, literally every day. And you see it, by the way, on the backside of M&A. To me, it's pretty clear that we don't have any hiring velocity today, and that the Fed, I think it's a pretty clear, you got to get that funds rate closer to 3%, if not at 3%. And so I think you've got enough data to do that, and you don't have enough data that suggests that inflation, certainly over the intermediate term, is accelerating. So I don't have any issue with the meeting. I mean, I think they can move closer to 3% sooner. So, and I think you got enough data to allow you to do that.
All right, so you think it's a lock, and it doesn't really matter. They might as well cut now if they're going to cut.
By the way,
I
don't think it's a lock. I actually think, when you look at, we're going to probably have some dissents. You probably have a disagreement. I think it should be a lock. Listen, I think the fact that we haven't heard anything otherwise, that they're probably going to go. But I definitely don't think it's 100% that they're going to go.
All right. That's interesting. So you think we're going to see more dissents. Does that continue, Rick, or do you think, once Jay Powell is done and the president puts in whomever his pick is for Fed next year, that we're going to see less dissent? Or is this a new feature of the Federal Reserve?
So personally, I don't think it's a crisis that you have some disagreement. You have some independent voters, you have some independent people on that Fed that are interpreting the data differently than others. So I'm not sure that it's a structural problem. Listen, I think that, to me, the data is very clear that inflation is a bit elevated today, but productivity and innovation will deal with that. And that is so clear to me. And then the flip side of that, productivity and innovation, are creating an incredible lack of hiring for ordinary jobs, lower skilled jobs, et cetera. And so, how people interpret the data in the near term, I don't think it's a structural issue that you have those dissents. I just think going forward that, we're going through what I think is the most extraordinary industrial revolution we've seen maybe in a generation. And I think the off-take of that is pretty clear in terms of what it means for jobs and inflation.
Let's talk about the next Fed chair. I mean, reports suggest that Kevin Hassett has won this contest, and I wonder, as someone who runs one of the most important rates businesses in the world, what do you think about Kevin Hassett as a pair of hands to run this Federal Reserve?
I will say that I'm not going to comment on any individual. The thing I will say is, I think this Fed will, continues to be one that will analyze the data. I think the data is clear today in terms of where it's going. I think the thing that we've got to do as market participants is think about not just what are they going to do with the front end of the yield curve, but what do you do out further on the yield curve? There's a bunch, including with the name you mentioned, how people think about how does the 10-year react, how does the back end react to that. I think one of the great expressions of the market today is I actually don't think that rates are going to be that volatile out the curve going forward. And so, one of the great expressions of the market today is selling volatility in the rates market, which has been pretty good trade. And I think will continue to be. Mortgages, agency mortgages, also being an evolution of that.
Mortgage rates and consumer borrowing costs are still high by recent standards. That's part of the reason, I guess, you want to get the terminal rate at 3%. But companies are telling us every day that tariff tariffs and policy uncertainty are more important than the Fed funds rate to their business. And we talk to economists like Diane Swank who say that especially consumers at the lower end are not going to be helped by a rate cut. Anybody in the subprime borrowing area, which is massive, by the way, is like the bottom 2 quintiles of the country. Are we in a world where rate cuts just don't pack the same punch as they once did?
That is a long and complex question. So I will say the answer is yes. The short term, the overnight funding rate is not nearly as effective a tool at moving monetary prices, at moving the economy as it used to be for so many reasons we've chronicled before. Service-oriented economy, people borrow out the yield curve. CapEx is not driven by the interest rate today, it's driven by hyperscaler spend or by CapEx spend on AI, et cetera. However, long-end interest rates do matter. And how you fund out in the 5 to 10-year part of the curve particularly do matter quite a bit. It's part of why I believe that stability out the curve is so profoundly important. To say, though, the comment about getting the rate down doesn't help low-income people is not true. The truth is there is a transmission mechanism that even if you move the front end of the curve down, as long as the curve doesn't steepen that much, and there are ways to manage that, what you do is you create velocity of mortgages. You get the mortgage rate down, you create velocity of housing. It allows people to unlock value of their house. It allows labor mobility because people can move. There's so many, and by the way, whether it's credit card financing, whether it's auto loan financing, to say that it doesn't help to get that rate down, I think is, for particularly the place that it does help, housing, low income, small business, and that's what needs the help today.
Mortgage rates have come down. I mean, the 10-year is at 4.1%. This administration has been steadily moving it lower. Where do you think we see the 10-year, say, at the end of 2026, since the market believes that the Fed will cut rates to 3% or even a little bit more?
So, man, I think the key is, so the answer is I think it's going 3.5 to 4. And I think the key will be maintaining stability in and around 3.5 to 4, because if you get to 3.5 to 4, you get the mortgage rate into the mid to high 5s. If you get the mortgage rate down to the mid to high 5s, you see it today. Why is existing home sales picking up? Why are you seeing, we see it in prepayment speeds in the mortgage market. You see high coupon mortgages that are widening relative to low coupon as a result of the fact you are starting to see some velocity around housing, existing home sales particularly. So if you get the 10-year, which I think can happen in 3.5 to 4, you get the mortgage rate in the mid to high 5s. And by the way, I don't think it has to go much lower than that. That's where you get, what I think is a much more effective operating ecosystem in the economy.
How do you control, or how does the Fed, as you said, focus on rates out the curve? We have a viewer writing in who wants to know, what's the mechanism to do that?
Many. So, if you are the Federal Reserve today, you have, when people say they have one tool, the Fed funds rate, I find that incredibly superficial. The handbook at the Fed has much more complexity to it. You can use the balance sheet, you can use their parts, if you use your voice, a la what Mario Draghi has done in the past, where you think about things like, gosh, if the amplitude of the curve is at a certain level, if the yield was at a certain level, you think about the size of the balance sheet relative to the duration, and you think about how you can be effective about using the long end of the curve. There's actually not that much, not to get too technical, duration, DV01 out the yield curve, that you can be pretty effective at managing that relative to the front end. To your question, your point earlier, front end, the overnight funds rate is interesting, but it doesn't, moving at 25 basis points every 6 weeks, doesn't do a hill of beans for really, until you move it to where it needs to get to. Unless you're moving it quickly, it doesn't really do that much. But managing further out the curve where corporate finance takes place, mortgage finance takes place, structured finance takes place, that has real efficacy to it.
I got to ask about BINC. You've outperformed the market universally 1.6%, 1.6 times the return, 1.8 times the return of the ag. So I'm just looking at the ETF that you run here. How have you got BINC set up for the Fed cuts, the path that you expect, and I wonder how the massive investment in AI, the huge borrowing that these hyperscalers are doing to build out this global network, how does that touch BINC?
So yeah, it's a great question. Thanks for asking. So I'd say a couple of things. My job literally is, I'll say there's something, I was looking at it the other day. Do you know in fixed income, there's 1.4 million unique securities? So you think about all the tranching of the debt, publics, privates, et cetera. My whole job and what I'm trying to do with, oftentimes what I find with lack of wisdom is all I'm trying to do is figure out like what is the best value across the markets globally. Where do you take interest rate risk? Where do you take yield risk? Where do you take convexity risk? So all we're doing and trying to do for people, because fixed income is pretty complex, is use our teams around the world. So today, do you reduce a little bit of your investment grade credit? Because to your point, there's going to be a lot of AI financing that will come. We've seen it in the last couple of weeks, few weeks. Do we need to own as much investment grade credit at tight spreads? Not really. It's not that exciting. Agency mortgages are more interesting. European high yield, European investment grade, we're not seeing as much of that AI, and the growth is moderate, and you get a cross-currency benefit. That's exciting. Having some interest rate exposure in places like Asia or in parts of the emerging markets. So, I don't know, the idea being just try and move around dynamically to where the best relative value is around the world. Today, credit is just okay. We still own, we still like high yield. We've reduced some U.S. Just because it spreads have come in a bunch. But we're just trying to create, if we can create 6.25 yield for people, stability. The thing I'm most proud about is we keep our volatility down. Like that's in fixed income. If you can get 6.25, and then take the risk in equities, to your point about AI and spend, pretty spectacular returns if you get it right around where the equity opportunities are.
Well, it has been. I'll tell you what, Rick. I put the Bloomberg data on your ETF on BINC into ChatGPT, and it came back with this. It says BINC has outperformed broad benchmarks by a wide margin while taking notably less risk. It's delivered equity-like returns versus the ag with roughly half the volatility, and it's captured most of high yield's upside with much smaller drawdowns. So high praise.
Thanks for saying it.
High praise from ChatGPT 5.1. BlackRock's Rick Rieder. That's just one of the many reasons we have him on this program. Really appreciate your time.